I got Oscar Garner here with me today. Oscar is nice enough to spend some time with me, living in the Detroit area, right?
Correct. Yeah.
Okay, so Oscar is with our asset management services team from Raymond James and covers multiple states. But Oscar, just give our audience a little bit of context, who you are, your background, and how you found yourself in the role that you do now.
Yeah. Personal side first. First off, thank you for having me. It's always good to spare some time with our advisors and talk about things that matter most, especially markets and clients and the work that we're doing back at the home office. But a little bit more personal about me, Oscar Garner from the Metro Detroit area. Born and raised Metro Detroit, lived everywhere from downtown all the way to Pontiac. If you know, you know. It's a wide range right there. I lived everywhere in the Metro Detroit area. Went to Michigan State University, so it's a big time of the year for us, right? March is Izzo season, so watching a lot of basketball right now. When I was at Michigan State, I was a journalist, so
Okay.
I wrote a lot of articles for markets and stuff like that. I actually had a Raymond James advisor who was reading my work and picked me up, sent my information down to the home office. This was during COVID, and I got a call from a branch manager saying, hey, what are you trying to do? So I got the call. I shipped down to Raymond James back around, 5 years ago, coming up on my 5-year anniversary here. And in that what seems like a short period of time, a lot has happened. I was an analyst for a short period of time, but I landed in our asset management group, which is a very important part of the firm and kind of what we offer at Raymond James. To put it lightly, we're the core of everything investment related. There are millions and millions of ways for clients to invest their money legally and illegally all across the world, right? Our job is to cut through the noise, look at the entire investment landscape and define good versus bad, signal versus noise, and cut through all of that and make solid investment decisions based off of process and discipline. But I don't do any of that. My job is to be a connector. You talk about covering multiple states. I like to say I'm a well-dressed middleman. I understand clients and advisors and what they're going through on a day-to-day basis, but I also speak the language of our due diligence team and what they're doing back at our home office. And I just relay that information week in and week out, traveling between Detroit, Grand Rapids, Traverse City, Indianapolis. I got Evansville on the clock in a couple of weeks. So I get around these two states, just sharing the gospel of what we're seeing down at headquarters and trying to get the word out.
Sure. Now, how does somebody studying journalism, Michigan State, let's spend a little bit of time there because you just mentioned that very briefly. So you're putting out articles. I'm assuming it's a part of some class, or is this just completely freelance on LinkedIn? How'd you get this out there?
Yeah. So, COVID will do weird things to you. You just start doing stuff,
No kidding.
I was a finance major. I call it investment banking school dropout. Basically, I was going down that route. And right before COVID hit, I kind of found out about the wealth management industry. I knew numbers and finance just with my background growing up in Detroit. My dad was a real estate investor, also worked in the auto industry around 2008. So, those two worlds collapsed on us. And so my interest became, why did this happen? And how do markets affect people's lives and investment decisions and risk? All that became just very interesting to me. So I studied finance thinking I would go to investment banking. It felt like medical school just with numbers or more numbers, right? I just didn't feel like going that route. So I found myself in our wealth management program. And it was a new program, had just started, and they needed a lead journalist to write articles for, basically create a voice for our group. And I took, that lead kind of editorial role. And you can still look them up today. It's called the Spartan Journal. You look up the Spartan Journal, look up 2020, early 2021. You'll see some of my material out there, probably still on the website now.
Very cool. So then pivoting to your role within Raymond James, you mentioned that you cover multi-state. So for somebody that doesn't know anything about the wealth management side of things at all, how do you work within Raymond James when you say asset management group? Your investment consultant, what do those things mean, and how do you help branches across Raymond James within those states?
Yeah, absolutely. I talk to a lot of students from Michigan State who have a very similar question, but they come from a sense of, just ignorance, and they're looking to get involved with wealth management, but all they know is financial advisor, right? And you want to educate them on the entire world of what this has to offer. And what I always go back to is I liken this industry to really any other industry, but one that's close to home is the car industry. For me, every business has three legs. You have the end user, you have the person that creates the product, and you have that intermediary. Not every business has that perfectly, but many of them have those three different layers, right? And so the guy who makes the car is not the guy who ships the car. It's not the guy who sells the car. Those are usually three different groups. Wealth management is very similar, where you have, I call it the bifocal crowd, the guys who wear glasses and count numbers and do due diligence and spreadsheets all day. They're more on the making the car side. They're building research, white papers, portfolios, analysis, all of this stuff. They're doing all this grunt work that sometimes requires you to be in front of a computer. Some of it requires you to travel, but it's very siloed, very targeted, and not very social. On the other side of it, we've got the Jasons of the world. We got financial advisors who are talking about markets, making recommendations, putting clients into investment products like ETFs and mutual funds and strategies, right? But how does that information kind of get in between the two? While we're doing research and looking at these different asset classes and where we think they're going to move and making our recommendations. And while you're going out prospecting and finding new clients who need financial help, who's going to make that communication? Now, we send emails and do webinars and stuff like that all day, but we're in this room, right? We're talking. So sometimes you can't see that stuff. My job, and I service about 450 financial advisors across 2 states. I travel 3 weeks out of the month, and I'm picking a city for the week. I'm going to be there, and I'm going to meet with the financial advisors in that area. We're going to talk about their clients, talk about their book and what's important to their world. Every advisor has a different client profile. Some work with business owners. They've got different pain points. Some work with athletes. Some have those guys have different pain points. And so my job is just to translate that information. And so, I know, we carry probably 300 plus products and dozens of research pieces. I can't say it's all banked up there. But I understand, at least 80% of it and know 80% of it. And so I just meet and try to consult and bring that information to help the advisor make a more informed investment decision when it comes to placing clients' futures in their hands.
Sure. I think that's the beauty of it too, is like, you don't have to have all the answers. Like, I wouldn't anticipate you have all 300 plus products on the top of your head,
No.
but I lean on you as you lean on the research and development team at Raymond James. So, we all in a sense work together, but the beauty of Raymond James is that although it's a big firm in terms of the size, it feels like a small boutique firm in terms of you really feel like you have a truly an extension of the branch in terms of support, either on a prospective client base or client base. Now, pivoting this conversation, just because when we initially put this date on the calendar weeks ago, couldn't have anticipated where we are today in terms of the stock market. Now, most of the time we talk behavioral finance, but given that we are in kind of this prime position to talk a little bit about of what we are seeing today. So markets pull back a bit with some of the geopolitical risks, as we call it, just meaning things that are beyond the lens of here domestically. What are you hearing from advisors within the states that you cover? You said 450 advisors. I'm assuming you probably haven't talked to every one of them, but you're having conversations, nearly daily with advisors. What are clients most concerned about right now in terms of where we are today?
Yeah, so that's a great question. 2 weeks ago, I did a series of 3 client events in Grand Rapids area, which is a little bit more of a family style, conservative area of the state, definitely more religious values and stuff like that. So conservative group, right? And we were doing some events over there. Mind you, you have to be aware of who we're working with. Our client base isn't people like me. I'm 27 years old, right? I do well for myself, but I'm at no point where, I need a financial advisor and we're dealing with millions of dollars here, right? We're usually dealing with somebody who is either on the precipice of or in retirement. And so for them, their main concern is always going to be, how exposed am I to the market? And how does that affect the longevity of my portfolio? I think a lot of people don't understand the type of almost uneasiness that people feel when that last paycheck hits that IRA or
Yeah.
hits that 401k, and you really depend on the world to do you a favor or two while you're trying to make it to the
Sure.
end of retirement. And so I think the main concerns that a lot of clients have, and it is somewhat behavioral finance related, is how do these certain things affect inflation and cost? That is a heavy hitter right now. Like, obviously we're going to get market volatility, but we tell clients all the time, only draw 4%, only draw 5% on that IRA. That's going to allow you to still grow and stretch those dollars out. But today's client is asking, does that 5% cover higher energy costs, right? We look at things like AI and these data centers that are driving up local energy costs alone. And we look at what's happening overseas where energy costs are coming up from, higher oil prices and that type of thing. That's not just energy, though. That energy is an input in business systems like myself, right? You saw the Jeep Wrangler I had outside that I rented from Hertz. What it costs to fill up that tank coming down here, right? How does that hit the bottom line of Raymond James? You probably don't think about, hey, the financial firm is going to be exposed to the energy costs, but clients are really concerned, like, do all things rise with this? And is my portfolio positioned to absorb that cost? The real deep-seated part of that too is, do I have to sacrifice my lifestyle to be able to do that? We're already living conservatively. Do I have to tighten the shoestrings a little bit more? Obviously, volatility in portfolios is always a concern, but I think now more than ever, will I be able to stretch my dollar as far as I used to is just such a major concern for the clients that we're talking to today.
Sure. Now, most of the people that you're referring to in terms of the majority of the clientele, they're either upon retirement or entering in retirement, or they've been in retirement for a while.
Sure.
No different than the athletes that we work with, but that could just be a different age.
Right.
Now, I've heard a lot of things in the last 2 years that the 60-40 portfolio is dead. It's over.
Yeah.
Just kind of curious from your viewpoint, because that's your world. On the 60-40, when we say 60-40, 60% equities, 40%, fixed income, do you still feel like that is a well-suited portfolio? Obviously, we know the generic based on your comfort with goals, your time horizon, how much you're spending. But in terms of, we look back at 2022 and we had stocks and bonds down both in the same year. When we, as advisors, most of the time, what we talk about clients is, the ideal world is that you don't have all the equities and fixed income pulling on the same side of the rope. So they have an inverse relationship. We look at 2022, it's kind of hard to explain. You had stocks down, you had equities, fixed income down, and then the cost of goods is, inflation was at 9%. So
Right.
Circling back, thoughts on the 60-40 portfolio? Does it still work? Do we need to change things? Do we need to consider other options?
Yeah, the 60-40 still works the same way vanilla ice cream and chocolate ice cream still work, right? I think that's going to be a classic portfolio that's always going to have a place. But the questions were not misplaced by any means. There was a period of time where, I could borrow money at a better rate from my buddy than I could, putting money in bonds. That was a bad environment for fixed income, where people were buying bonds paying 1.5%. And then you throw an advisor into the conversation and costs kind of eat into that. That's a tough environment for the advisor and the client. And at that point in time, I'd probably be willing to sign up for that conversation. A lot of people were shifting from fixed income to dividend paying equities, which is a whole different conversation, right? That's risky in itself. I think where we stand today is very different. It's not just about the new income that we're getting on the fixed income environment. I just saw some CDs, a couple of days ago that are expiring in a couple months, paid in 3.8, right? So we have decent yield on the portfolio. We even saw some of our portfolios in Freedom Fixed Income, which is our internal asset allocation model, return close to 8% in a fixed income model alone last year, right? So there's opportunities to take credit risk and get yield, and it's a different environment than what it was before the rate hikes of 2023 and 2022. What to be mindful of today for the 60-40 and why it still works is every portfolio needs something to zig and zag. You need to be able to depend on your different asset classes, your different investments to move independently. obviously there's going to be some correlation between the two, and they might move together in extreme moments. But when you have volatility like you have right now, you want your S&P 500 to go down 5%, and your bonds to go up 50 basis points, 1%, 2%. And that type of activity, we're seeing that come back to the market. We've actually seen it be a part of market activity probably for the last year and a half. And that is a really good sign for us, because that's the role fixed income is supposed to play in the portfolio. Now, again, to your point, if you have a different timeline and all this different stuff, maybe the 60-40 isn't for you. But for those clients who land and say, hey, I am a middle of the road investor, I want to take some risk, but not a whole lot, that's the portfolio for you. Now, the other thing to be mindful of is, what are your equities doing? If you have stocks that when we get a bad headline, they all push down, that's not zigging and zagging.
Yep.
That's things all moving in one direction, right? That's never a good sign. And so part of our job at AMS is to make sure that even in our stock portfolios, things are zigging and zagging as well. So it's not just the 60-40, but it's also making sure that you don't own stocks that all do the same thing, all move the same way. That interaction has to be a part of the full portfolio.
I think you actually bring up a really good point, which I wanted to ask you. Most of our clients aren't sitting up late at night thinking about growth versus value, or quite frankly, I would say the percentages of clients that truly grasp and understand that, our hope is more than a few. But looking just specifically the last like 6-7 years, I mean, growth has dominated the scenes, right? So your larger companies that are taking shareholder money, reinvesting it back into the company, as compared to your value companies, which are maybe a little bit more boring in nature. They don't go up as much, but they pay the dividend. But man, if we really just hone in the last 6-7 years, with the exception of obviously 2022,
right,
growth has dominated the scene.
Absolutely.
But one thing that we're constantly educating clients on is, history is great, but it doesn't often always repeat itself. And the one thing I like to put in front of clients is the jelly bean chart, which nobody likes looking at. But it looks nice, but all it basically is showing is essentially that we can't predict the future, right? If we could, and I tell clients this, if I could predict the future, I wouldn't be talking to you.
Right.
Be on the beach day trading somewhere, life would be good, right? But that's not the reality, right? And knowing that, we need to put our clients' assets and put ourselves in the best situation to be successful. That being said, millennials, which I'm a millennial, really since they've entered the workforce, 2018 and 2022 are the only down years in the stock market, which in terms of relative and times are blips on the map in terms of like the actual pull down. So I always feel as if my age group, millennials, haven't really experienced like a true financial downturn. So I guess the question where I'm headed is growth and value. Is there still value to being equal weight, or what are your thoughts on growth and where it is and where it's headed?
Yeah, absolutely. And again, liking this back to our client base. We usually have this conversation with somebody who these features and factors we're talking about are far more relevant. Somebody with a different timeline for investing maybe isn't as invested in this conversation. But what I would offer is that while value has been sleepy and the performance or the lack thereof, there really hasn't been much to write home about, we are entering into a new environment. And you kind of saw this in the last 6 months of the market. I don't know if this trend continues, but follow me a little bit here. In this day and age of investing, I think there's a shorter attention span than ever before.
100%.
Where investors get very, I don't want to say bored, but almost fatigued. Earlier we were talking about AI. Like, hey, AI is a great story. AI would probably change our lives, but we're already bored about talking about it, right? And one could say we're barely out of the third inning of that conversation.
Yeah.
So just to conceptualize that, hey, the attention span is a little bit shorter than it used to be. And I think you saw this in the market. In the last 6 months, you start to see not the market really fall off, but the money start to redistribute, right? Hey, we made our money in NVIDIA, Broadcom, Google, Meta, Microsoft. We've kind of made our money here. The earnings haven't really caught up to what we bought it to. Either I can wait on that, or maybe there's some benefits elsewhere in the market for me to go get in the meantime. Right, we talk about Mag 7, but the S&P 5, and we talk about the S&P 493 as if they're the redheaded stepchild. These are still some of the most dominant companies in the world. And people will, they'll write off or they'll write off McDonald's, that's a value, Coke, Honeywell. They'll write off some of these stocks as value stocks, and say they're sleepy and all you can get out of them is a dividend. And they're really valuable to an older client because they're stable and they pay that income. But what I would challenge is that the value space will present more opportunities for AI than the disruption in the software space. Obviously, people are going to buy these tools and whatnot from software providers like Meta, like Microsoft. Obviously, they're going to be involved in the transaction. But if we could limit product defects for Coca-Cola and cut them by 50%, can you imagine what that does for Coca-Cola bottom line? And that was all just an AI implementation. I wouldn't even consider buying Coca-Cola in my portfolio because I'm okay bypassing the 6% dividend or whatever it is these days. Or if McDonald's can find some way to make ordering better and just-in-time ordering. I can't even fully express all of the efficiencies that the growth side has produced for the value side. But I think it does exist, and it's worth being mindful that those areas can take back off. They might have matured with the technology that they had yesterday, but that's not the technology that they have today. So I know you asked directly about growth versus value and where does that go from there. I think, in the last 6 months, you see that money redistribute around to these other stocks and these other ideas. And I think that will continue as long as AI is able to deliver new operational and cost efficiencies that didn't exist before, because for a lot of these companies that goes straight to the bottom line. Either becomes a dividend or it becomes earnings growth, which means the stock becomes more valuable, right?
Sure. Now, since we've mentioned it, let's stay here for a minute on AI. Not completely ignore it because it's very much a part of my life nearly every day. Clients are wanting to talk about it. Nearly every wholesaler that comes to the office can't really ignore it, or escape from it. So talk about it within the firm first, because a lot of people are familiar with Raymond James, but really aren't sure how we're using AI. I know we're spending over $1 billion in technology alone annually, which is great. We have a couple different platforms that we can use, and from an advisor standpoint, cleans up my emails, but it can also do a lot of other things if you know how the tools to equip yourself with. Talk about a little bit about how, like Raymond James, from an asset level or an investment level perspective, how the firm is implementing technology, specifically AI, throughout the firm.
Yeah, absolutely. So, I'm not familiar with the full network of the firm. There's probably like 8 different product areas that resemble asset management services. But the good thing is we're probably responsible for 70% of the assets at the firm. So what we're doing tends to lead the charge a little bit. From the asset management perspective, we've been doing a lot of our trading and operational and processing and stuff like that fully by hand. It's been a very by the people's business, and we're not replacing anybody by any means. We haven't done any layoffs or anything like that. It's not in the cards. We pride ourselves on people before technology at Raymond James. But what we are doing is that where it took maybe 2 days to process an account and implement and trade and whatnot, we're using technology to be able to speed up that processing time, which doesn't really do much for the bottom line. But what it has done is earned us more goodwill out with advisors and clients because, hey, we're getting money into the market faster. We're implementing strategies faster. We're getting through processing faster. And the advisor is looking like a hero because the client's having a good service experience. And so from the operational side, we're using it to process forms, process trades, not by itself by any means, right? This isn't an independent tool. Our traders are still there. They're still the last step or the final mile, whatever the last inning of the processing experience. But a lot of the manual piece that could be handled by a technology is now being done, and we're integrating AI there. From a business development perspective, there's 12 of me that travel the country. We got a guy, my guy Kevin Wonker out there, right?
Yep.
And so there's a few of us out there who meet with advisors. We funnel all of our notes into one SharePoint page, and we take meticulous notes on everything from advisor sentiment to success stories, failure stories, where we, feedback, all of that stuff is compiled. I do about 15 meetings a week. You multiply that by 12 guys and 3 weeks out of the month, you're getting a great data set directly from the field. And we're using that to find areas where, hey, across the country, this is what we're not doing good. This is what, or this is a great opportunity for success for us. Or here's some low-hanging fruit that we could address with just some marketing pieces and stuff like that. Here's a follow-up item that we could automate. So those type of things, we're using AI to read that data. I'll even take it even more granular to my region. Obviously, I run Michigan and Indiana. I pulled the business numbers for us, and I looked and said, like, hey, what was having a lot of success last year that people were using that they're not using this year, and vice versa? And said, hey, here's a couple, and I can't get into that I can't get too much into that, but it identified a couple gaps where I was like, wow, I didn't realize these people weren't asking for X, Y, and Z service anymore. Or they weren't looking into this strategy as much anymore. I didn't realize that this strategy started to take off. It's getting a lot of play. I don't understand why it's getting that. Then I investigate it, have a better understanding, so I can be more informed in my meetings. So we're using it all across the board to enhance the delivery of our intelligence and streamline some processes and make them a little bit faster.
Sure. Now, as far as AI is concerned, one of the things that I feel like I like to talk about are, yes, everybody wants to talk about AI, but are there things outside of AI? Like, I think one of the prime examples from my viewpoint is that since I've gotten into the financial services industry, every single year, wholesalers have been telling international. And they were bound to be right one of these years.
Yeah.
And, well, look at what international has done over the last year. It's done pretty well. Not using that as the example here, but where do you see there lying opportunities in a world that does not include AI? Or if it is AI, maybe not the specific, is it infrastructure to the AI, or what are you seeing right now?
Yeah, so I think energy is going to be at the center of the conversation going forward. AI kind of gut punched the wall a little bit. I don't know if it's going to be the driver that grows our energy infrastructure. I don't know if that's going to be the case, but I think what AI exposed is that the US specifically is massively behind when it comes to energy infrastructure. We do not have the electrical grid to even implement electric vehicles in an efficient fashion, right? You travel to certain parts of the country, you literally don't have that there, right? It's almost like a foreign concept to them. So energy infrastructure, when it comes to delivering clean, dependable energy into the future, to be able to meet the needs of a developing more service and technology-based society, that's going to be important, whether it's AI, electric vehicles, whatever comes. With the capacity that we have now, we're capped for growth. And we can only push as far as that energy grid allows us to go. Now, am I advocating for nuclear or stuff like that? It's not a political stance or anything like that. It's just a true numbers that we can't take on the capacity that AI needs to be able to, some of these people talking about replacing jobs and all that. We don't have it yet. And that's my main concern with the growth of the AI space. And no, I'm taking the question in a little bit of a different direction. But my main concern is, do we have the energy infrastructure to support AI? But even expanding that more, do we have the grid that we need for the future? I think the answer to both questions is pretty obviously no. And you ask Sam Altman on a public stage, a setting just like this, he'll say the exact same thing. And so, as an investor, what does that mean? I think for you have to look at, when we have infrastructure issues, who usually comes to save the day? Usually it's Uncle Sam. Usually it's some sort of spending or tax breaks or something like that. So there's going to be incentives for utility companies and energy distributors and energy miners to start to develop and grow those networks and find new ways of getting us energy in a clean, predictable, efficient fashion. There's going to be pressure to do so, and there's going to be money involved with that. Where do you invest? Obviously, I can't make a security recommendation here or something like that, but that's a space that myself, I'm looking at in my own portfolio of how do I kind of get my hands on the picks and shovels of that space as, if this is to continue, this has to follow, right?
Yeah.
Almost like the parlay of the market, right?
Yeah, and it seems like the figure that I've heard is $6 billion that the U.S. is investing in AI. Now, the earnings behind that is kind of the mystery. And we have a lot of forward momentum with it. And it seems like we're in a position as a country where what we don't do exposes us to being vulnerable to what other countries could do. So it seems inevitable that the growth should continue to happen. But at what point do we stay? We got to see some sort of earnings here because this isn't all adding up. Or do we keep pushing the can down the road thinking that this thing's going to be marvelous and great and eventually we're going to have less people working but be just as efficient? Like, when do those roads cross?
Yeah. So the one thing to remember about paper assets, right, financial assets, is they always overshoot to the upside or the downside. Always. There's never a middle ground where we say, you know, hey, we're not going to trade today because I think the market's perfectly priced. Until we get new information, like, we're not going to make any changes. So we're always going to be playing this overswing, underswing. Are we giving it enough value? Is it going to grow? Or we haven't seen it catch up yet. I'd say if you want your answer to that question, I think you just look at the market today. If you open up a map of the S&P 500 and where performance has come from year to date and over the last 6 months, you're going to see non-Mag 7, non-tech, non-AI names. Does that lift come from just a general rebalancing into other parts of the market? Maybe. Is that coming from people saying, hey, AI hasn't produced the revenue or earnings growth that we needed to see to constitute this investment? I think you could easily say that is happening. How much of that is playing into the performance we're seeing right now? Obviously, we don't have that answer. I think those are two major factors, however, and I think if you ignore those, you're being obtuse to the situation. So I think you're seeing investors right now say, until you can show me the next incremental dollar, I won't invest the next incremental dollar, right? And the sellers are winning in that conversation so far in the last 3 months. And I think it's well constituted. Look, 2023, 2024, 2025, you don't hit 3 home runs like that in a row. I think we were up 20+% 2 of those years back to back, another 16 last year. I'm probably misquoting it. But if you were an S&P 500 investor or even a Mag 7 investor for the last 3 years, depending on what you held, you might have doubled up. That's insane, right? So one could say that's an overshoot. One could say it's warranted. But I think if you look at the market today, they're saying we haven't seen what we need to see to keep putting this money at risk. In the meantime, I'm still going to show you some love. But my 10% overweight is probably looking more like a neutral weight these days. Yeah. And I'll overweight until I see that next piece.
That's interesting. And a lot of the clients that we're having discussions with right now, I mean, in terms of if you're a long-term investor, especially if you're younger, right? We know that market fluctuations are normal and quite frankly, they're necessary, right?
Right.
And so within a given calendar year, typically speaking, we have 4 to 5% pullbacks, and we usually have 10% pullback. That's we already know historically. Whether or not that happens is obviously subject to be determined. But one thing that we're constantly talking about is dollar cost averaging. Super boring to talk about. But in terms of, hey, if I'm a young investor, I got some money to work, more longer term, we're always trying to encourage getting into the market by dollar cost averaging, which just basically means setting a fixed amount a month. It could be biweekly, it could be monthly. But what it allows our clients to do is avoids the temptation of staying on the sidelines. But what it also does is if we do experience a pullback in the market, it gives us room to add. So, things that come to mind for us are guys that sign these larger bonuses. Getting into the market right now, huge believer in it, right?
Yeah.
There's nothing that we haven't overcome from yet, right? We have all the history and data points and graphs that we could show them. But getting in, at the peak or close to the peak, obviously we've had a pullback here as of recent, feels a little bit uneasy. So the analogy that I always use is, hey, we're going to get your assets fully invested, but we're going to get into the market as if we're getting into a really cold pool, right? Mm-hmm. You're going to dip your foot in and then your calf and then your leg, right? We're going to slowly get in. And, I found that using the analogy, getting in that way helps these younger investors grasp really what they have in terms of the opportunity set forth with them. Obviously, we don't have the crystal ball whether to know if the market's going to pull back or not, because the reality is they could keep buying at higher prices.
Yeah.
I don't know. But I find that helps younger investors really grasp today. They don't need to understand maybe the nuances, like, hey, how does that affect my portfolio?
Right.
Like at a micro level, yes. But if we look more macro level, is that going to impact anything you're doing in terms of this portfolio in the next 15, 20 years? No. Okay. Given that, if we had extra cash on the sidelines, this is where we kind of, add that money, get it to work, where you're essentially, I always, again, use this analogy is like, you may feel like your boat is sinking a little bit, when the market's going awry, and you're probably not feeling it as much as like the S&P, right? You have conservative investments, you have small, mid cap, international, all the asset classes. But if we're able to add cash and kind of put holes in our boat with the cash, right?
Sure.
You're using that visual to where, that boat stops sinking maybe as much. It doesn't mean you're not going to continue to bleed, right? If we add dollars here, it could continue to go down. But the thought is that we add dollars down here and that, hey, in 1 year, are we going to be in a better position? 3 years, 5 years, 10 years. What's something, maybe that from your viewpoint, talking to advisors, that you feel like, dollar cost averaging was just one example that I give, but, that can help clients during time of volatility or times when the market's pulled back a bit?
Yeah. So I'm a very philosophical person, and I break things down. It's cheesy, it's hokey, but day doesn't exist without night. You have to help people understand that you cannot have one without the other. If the market only moved up, it'd be a Ponzi scheme. Like the only time that a strategy has only moved up, the guy died in jail. His name's Bernie Madoff, right? That just it doesn't exist, right? And you help people understand that these are the highs and lows. If I even relate it to the athletes, man, did you hang it up after a bad at bat, bad strikeout, right? Bad inning, bad game, few errors, maybe a bad season. Did you hang it up, or did you retool? Put some cash in the holes, or however you want to put it. Did you come back again? No good season or no good story isn't made without the early exit or something. Like, it's all a part of the experience. To get that, you have to go through that. I think a lot of clients also, they look at like a 5-year average number, and the average number says, 12%. Okay, the strategy did 12% over 5 years. And we go into year one, and it does 6. And they're like, where's my 12? It's a 5-year number. It's only made via the 5 years. Like, LeBron is one of my favorite players. LeBron averaged 27-7 for years. LeBron only had a 27-7 night once in his career. He had to put all those different high and low games together to get there. So we always talk about it's all part of the story. But for clients, especially those who have made a good amount of money and they have money outside of the non-qualified accounts, sometimes it's about offering somebody something to appease them in the meantime. And one thing that's been very popular at asset management services and Raymond James is this idea behind tax loss harvesting, especially in this environment where you have the market can move. We had like a 1.5 point swing or 1.5% swing. I think it was Friday last week where we just shot down, right? Our clients who are using tools like direct indexing or tax overlay service or just aggressively tax loss harvesting their portfolios, at least they can leave these volatile times saying, okay, cool. I banked this loss. I can use it on my taxes. I can spread my wealth. I can kind of extend my wealth for another couple of years because I was very aggressive in loss harvesting this year. And so at least you feel like I lost some money, sure, but I made it worth my while in the meantime. That's a way that we can kind of make clients indifferent because I'm getting benefit in either direction. Obviously, number one's always going to be making money and leaning on your advisor to reposition portfolios, leaning on asset management services to give you intelligence and insight. Obviously, we want to reposition to make money, defend clients' assets. We obviously want to do that. But sometimes, like 2022, there's nowhere to hide.
No.
Right? So how do we make it worth their while? That's something that we're doing that can help that conversation.
Yeah, and I'm glad you brought up direct indexing, not to talk about products or sling products or anything like that, but that's been something in terms of volatility, right?
Yeah.
One of the things that can bridge the gap, right? Because you get in down low, you could argue that's a decent time to get into a direct index strategy, but you could also make that same argument at the peak, because it's inevitable that we're going to have a pullback, which is what we've seen the last couple of weeks. And typically speaking, prior to direct indexing being more widely adopted, financial advisors, right, they look at the brokerage account, which is just a non-qualified, non-retirement account, right? Okay, what's in the red come December? Okay, XYZ mutual fund. I'm going to sell that, swap it, I'm going to harvest the loss. But the beauty of direct indexing is it's done via, algorithms from several of our different partners, but it's basically an active tax loss harvest machine.
Yeah.
So it takes off, the pressure from the advisor standpoint of trying to find those opportunities throughout the year where it's done by the partner, but from the standpoint of these losses and how that matters to clients' portfolios long term, it's not, our goal is to educate them, to get them to understand that the return is part of the question, but then what you keep is the other part of the question. And getting them to fully grasp that is when you see the light bulb finally going on, because people hear losses. Wait, whoa, gosh, like I don't want any losses on my portfolio.
Right.
But there's portfolio losses and then there's tax losses. Tax losses, are a thing that can be beneficial to you in the future. And the beauty of it is that you can carry it infinite amount of years, right? Yeah. Hypothetically speaking, what you're doing today in harvesting losses could benefit you next year. It could benefit you 3 years, 5 years. Quite frankly, if you're a business owner, there's a lot of situations. We've had a lot of success stories from simply diversifying an asset, right, an over-concentrated stock position, all the way down to cash on the sidelines, getting into the market, and in just the brief time that we've had in 2026, it's obviously we don't know what the year's going to end, but this is where the harvesting feature of direct indexing can be so beneficial. Are those the types of conversations that are being had with advisors to their clients from your viewpoint, or in terms of the direct index strategy?
Yeah, that's a big conversation. If I could even zoom it out too, because obviously we don't want to talk product here. Like, let's just talk about where we are in the world today. Looking at the U.S., we've got this thing that some people call it peak 65 or the silver tsunami, right? We just have so many people who are crossing that theoretical threshold of working, earning money to subsisting off of their portfolio, right? And so for those folks, what does their investment career look like for the last 20, 25 years? They, in the dot-com bubble, bought some of those tech stocks. In 2008, bought some of that large cap equity, scooped it up. The basis is zero, probably on a small piece of paper somewhere in the attic. Probably barely spent $5 on a stock worth $500 at this point. And so those equities have ran, and the gains are massive. Now their concentration, they have a million, something like that, across 3, 4, 5 stocks. That's great for when you're trying to make money. That type of concentration makes you a lot of money if you pick well. But now you're at the point where 2xing, 3xing, 4xing your dollars over the next couple of years, that's not the mandate. You're worried about, I'm peak 65. Family history says I'll probably live to around 85, 87, somewhere. I got to get this to stretch. Now, the IRA, we can trade that because there's no tax implications.
Sure.
Or limited, right? We can trade that and reposition it all day long. But for your big stocks, I have to diversify you. But I can't diversify you without the tax bill. And we just have so many clients who understand I'm putting my wealth at risk because 25% of this huge account is in this one stock. If anything were to happen to this business and it got nuked, I'm in a totally different situation. What once was a portfolio that could last me 20 years is now 17. And now maybe I have to be more aggressive for longer. It's almost like betting, right? If you're down, people bet more. It creates this behavioral loop that is terrible. So what we do is we offer things like direct indexing as a way to keep people invested, because having exposure to the market is key. Time in the market, we talk about it all the time. But being able to use losses to offset gains is going to be an integral part of the longevity of your assets. And clients don't realize that, because there's this concept of tax drag, and I get really passionate about this topic because
this is what keeps you up at night.
It keeps me up at night because we have so many people retiring who are in this, business owners who are in this position. You built up this wealth, and now because you didn't structure the exit the right way, you take a 25% hit straight to the face.
Yeah.
That's taking longevity off. It's even more silent for people who aren't business sellers. Like, they just got these positions and maybe they're thinking about trimming them over time. And so they pay the taxes along the way. But then you get this thing like tax drag. Tax drag will never kill anybody. It'll never destroy your portfolio. But it's almost like a cyst or something like that, that if something else happens, you are already weak. It's like a bad immune system to your portfolio, right? And tax drag can be 1%, 2%, 3%. Over time, that 2% drags out. So here's the money that you make, but because of that tax drag, you're staying here. Now, nobody sees it because they don't see the two lines. But if you can educate somebody and say, hey, this is the money that you make, but based off your tax bracket and your RMD and all this stuff, this is how much money you'll actually end up keeping. And what I want to do is try to offset something like that and maybe keep half more. Close that gap by 50%. Being investment minded, or being investment alpha oriented, right? Alpha being outperformance, is going to be just as key for some folks as being tax alpha, tax minded as well. And so, you know, the not to talk directly about direct indexing, but this is just such a big part of where we are as a country because so many people are in this position that I think this conversation is only going to get more important as time goes on.
Yeah, and it's the quickest way to become ultra wealthy is by being over concentrated, but same could be said on the flip side of that. I mean, I think sometimes we get ignorant enough to realize that there are the Enron stories.
Yes.
And, you know, you invest, your paycheck comes from your employer, maybe your stock options, right? There's a lot that's tied into one company, and then to have a good portion of your net worth tied into that too is super risky, and it could be beneficial, right? If I was an NVIDIA employee and I've been buying stock all along, I'm feeling pretty good about myself. But there's also the other side of the story in terms of, hey, how close am I to retirement, and is the risk reward really worth the squeeze?
Right.
And I think that's it's hard to, right, in the example of NVIDIA, right, diversify that into an S&P 500 index, right? Like, you have to kind of go underneath the hood and explain exactly what you're talking about in terms of the tax alpha and get them to understand it. Otherwise, when you're looking, hey, why would I invest in something that's returned this versus this and it's done well? What are we doing, Oscar?
Right.
But getting them to understand it is a whole other side. Now, as we wrap up here, I want to spend a couple minutes on your viewpoint on this. Because I've been seeing a trend recently. It's like I'm having a lot of conversations with clients that they may have kids that are entering into the workforce. And kind of like an awkward time. I, in fact, saw the CEO of NVIDIA talking recently, like, hey, if I'm hiring 2 people right now, you know, for the same position, and one's an expert in AI and one's not, like, I'm going to choose this person.
Right.
You know, what would you say? I know you're not 21, but you're also not 40.
True.
Like for you know, the workforce entering into right now, what would you say is the biggest key in terms of getting started? Should I be focusing my time on AI? Should I find the boring job, right? The plumbing, because, hey, I heard AI is taking that too. Like, where would you tell the younger generation that's entering into the workforce on what to do in terms of how to get a job or what to be looking for?
Yeah. So again, I philosophical. I look back at life, and I do want to remind everybody that this has already happened. Every era of technology development, right? They replaced a train conductor. There was a class of kids who were like, I can't be a train conductor because they made the cars, right? So obviously, industry changes, job roles change. We don't dig graves anymore. You know, we don't write Bibles. Things change, and so I think not just learning AI, but being mindful of the type of role that the new AI environment can create and positioning yourself for that is going to be very key. Taking the time to, and a lot of people say this, but it will pay dividends. I did it for myself. Taking the time to learn the infrastructure of AI and technology. I did this myself with my CFP, my Siemens, stuff like that. I knew that was going to get me ahead at that time. Those licenses maybe aren't as relevant because you can take the CFP book and go right to ChatGPT and say, know the same stuff I know, if not better. I'm just calling it what it is, right? But if I'm in college today, I'm leaning on one, understanding the technology and how it's going to change my industry, at least getting the best idea of that and positioning my skills to serve in that area. If it's understanding prompt writing, if it's AI, agent engineering, whatever that may be, if it's cross-system functionality, if it's how to separate a data set, somebody's still going to have to use these systems. And I don't think personally we're ever going to get to the point where we're at a full replacer mode. And you know, maybe this is a different podcast, right? But the other thing that I would say is that social capital is more important than ever. I'm somebody who comes from a line of 2 auto workers. I'm Oscar Garner III. Junior worked in the auto industry and did the best that he could, you know, flipping houses and whatnot. God bless him, put everything on the line for us. Senior, I don't think Senior even went to middle school. Senior came up from the South, found a job opportunity at the plant, put my dad on, put my aunt on. Everybody wore that Chrysler, what do they call that Chrysler overalls on the line. And so, sorry, I get emotional about the topic, right? But yeah, I look at that story and I liken it to you have to reinvent. You can't look at what's happened before and think that same opportunity is going to come again. You have to be willing to look at other opportunities. My dad understood that better than me, and he put me out there. And he put me at the golf course to, you know, I was a golf caddy growing up. He put me out there because the social capital was what I could get there that I couldn't get at home or from our network of people working at the auto industry.
Yeah, makes sense.
And that's no shot at them. That's no shot at them. But if it weren't for the network that I built up caddying at Oakland Hills, if it weren't for the network that I built up writing stories at Michigan State, if it weren't for the relationships that I'm building at Raymond James, I don't sit here today. Social capital is what turns somebody who's hidden and exceptional to a successful rising star. You need to find relationships with people who are willing to advocate for you, especially if you come from a background like myself, where you don't have people doing what you want to do. The good thing is today is those people like talking about themselves. We're on a show right now, right? Go find podcasts, go find these kind of lesser known YouTube channels, all these different things of people who are really successful in their own lane, have their own platform, willing to share their ideas. Reach out. You have to put yourself out there. It's all about statistics. There are certain people who are willing to help you. And by multiplying those people by iterations of reaching out to them, a stone will be unturned and an opportunity will reveal itself. So you have to find those. And when that opportunity does reveal itself, you have to be ready by having the skills. Skills of knowing where your job or industry is going, the social capital of needing connections to advance your network and advance your lifestyle. Combining those two can make something very special and help you rise above the current talent. And so if you want to do anything meaningful in this new AI environment, you're going to use those two different things to circumvent the current barriers that exist today.
Dude, that is awesome advice. I can't wait to clip that later. Last question as we wrap up here. I always like to ask our guests, what do you feel like the best investment one can make? This doesn't have to be an actual product.
Yeah.
Okay, and I'm going to actually challenge you on this one to say not invest in yourself. So that one's taken too, because I've had a couple guests, and I'm like, I gotta prevent that.
You gotta put a wall up.
Outside of investing in yourself, and it could be a product, like I said, but what would you say is the best investment somebody can make?
Driver.
A golf driver. But I mean, to your point though, the driver could have been a social thing for you that got you where you are today. So although symbolical and fun to laugh at, like, could be partly the reason why you're here in this room.
So real answer, and everybody should, if you're going to be in the space investing in your driver, please do. I started too late.
Probably need to.
So what I would suggest, I read this book couple years ago called Lattice Work. It's one of the best books I've ever written. Now, he did product pitch me at the end of the book, and I closed. I was like, I'm done with this. But for the first few chapters, what he talked about was the integration of studies and topics, how understanding biology and understanding psychology can help you understand physics. How by understanding physics and psychology, you can understand finance. And so I know this is like almost a variation of investing in yourself, but being able to, I think the worst mistake that I made to be in this industry, if I could find a way to get into this industry without ever studying finance, I would have done that. Because your ability to relate to people from different backgrounds, there's no words that I can say about how that can be life-changing. Being able to sit down with a professor from, I'm going over to Terre Haute tonight, a professor from Indiana State.
Let's go. Go Blue.
A baseball player from Cincinnati or a high school teacher from Traverse City, being able to relate to their different experiences without having lived them makes you a palatable human being in so many different ways. And especially if you're going to go into something that's social or sales or wealth or something like that, right? Really anything is sales because you're always selling yourself, right? You're always trying to advocate for yourself. So you need to have a wide base of knowledge, not too deep, right? Doesn't have to be a mile deep, but having good understanding of different schools of thought, different philosophies, history, and stuff like that. Being well-rounded in that way, it's life-changing. So I would definitely suggest that.
And I am going to plug in a way to find you through our compliance channels here so that people can find you on LinkedIn, right? Like because I have a feeling once I clip this little 5 to 7 minute advice piece there for college kids, I think you're going to get a lot of people reaching out to you. So where can people find you to connect with you?
Oscar L. Garner, III, as some people call it, Oscar L. Garner III, CFP SEMA on LinkedIn.
Awesome. Oscar, I really appreciate the time, and it was a pleasure sitting down and chatting today.
This was great, Jason. Thanks for having me. Hopefully we can do it again.
Yes, sir. All right.